Imagine a small company whose technology is already a foundational standard in one industry, and now it's quietly positioned to power the entire future of autonomous vehicles. But here's what our deep dive uncovered that makes this truly interesting. Its current stock price seems to tell a completely different story than its immense underlying potential suggests. Today, we're going to unpack why this fascinating gap exists and what it might mean for the road ahead. Welcome to the Deep Dive, where we sift through a stack of sources and distill them into the most important insights for you. Today, we're embarking on a custom-tailored deep dive into Valens Semiconductor, ticker symbol VLN. This is a microcap Israeli innovator, currently trading around $2.68 a share as of July 7, 2025. Our mission is to dissect its business model, management's vision, financial health, and risk profile to build a holistic perspective. We're going to explore whether this company truly stands at the precipice of a far larger opportunity. Okay, let's unpack this with part one, the foundation. We'll begin with Chapter 1, Business Analysis, the Architect of Next-Generation Connectivity.
A core question that immediately surfaces when you look at Valens is this. Can a relatively small Israeli innovator, already a standard setter in one industry, successfully replicate that standard-setting success to become the absolutely essential connectivity backbone for the autonomous vehicle revolution? That question really anchors our entire analysis, you know?
That's right. And to understand how they might do that, let's start with their core business. Valens operates on what's called a fabless semiconductor model. This is key. They design the incredibly complex chips, much like an architect designs a building. But they don't own the massive, expensive factories to build them. They outsource manufacturing, which keeps them agile and focused purely on cutting-edge innovation without the huge capital expenditures of owning chip fabs.
And their business is really split into two distinct segments. First, there's their cross-industry business, or CIB. This is their mature, stable revenue base, making up about 70% of their Q1 2025 revenue. It serves a diverse range of non-automotive markets like professional audio-video, think conference rooms and digital signage, as well as education, industrial automation, machine vision, and even medical imaging. It's their reliable workhorse, basically. The second segment, and certainly the one with the most long-term buzz, is Automotive. This is their primary growth engine, currently around 30% of their Q1 2025 revenue. Their solutions here are crucial for advanced driver assistance systems, or ADS, in-cabin infotainment, and the increasingly complex data backbone needed for truly autonomous driving.
So what actual technology powers these segments? Valens is perhaps best known for its HD-based technology. This is their original standard-setting innovation for the Pro AV market. What our sources really highlight about HD-Base is its 5-play feature set. It can simultaneously transmit uncompressed Ultra HD video and audio, Ethernet, control signals, and even deliver up to 100 watts of power, all over a single standard LAN cable for up to 100 meters. Why should you care? Because it dramatically simplifies complex AV installations, cutting down on cabling and setup time, making life much easier for installers. Their flagship chipsets for this are families like the VS3000, known as Stella. Now, they've skillfully leveraged that same expertise into the automotive sector with their MIPI APHY chipsets. This is a game changer.
It really is.
Because Valens technology was selected by the MIPI Alliance as the baseline for the APHY standard. This is significant because it's the first industry-wide standardized solution for asymmetric, long-reach, high-speed in-vehicle connectivity. We're already seeing products like their VA6000 in Mercedes-Benz vehicles, and the VA7000 has already secured design wins for 2026 models with multiple European OEMs. It's powerful validation.
What's particularly striking is their market position. Despite being a microcap company with a market capitalization around $276 million, Valens wields significant niche influence. Our sources describe it as a hidden gem because its chips are embedded in products from global giants like Mercedes-Benz, Logitech, Samsung, Siemens, and Bosch. They hold a commanding, standard-setting position in Pro AV through HD Base-IT and have secured a crucial first-mover advantage in the emerging MIPI APHY ecosystem for automotive.
Right, influence despite being microcap. So their primary value proposition. Across both segments, it's really all about delivering more for less.
Exactly.
They provide incredibly resilient, ultra-high-speed data transmission with zero latency and a really low error rate, all over simple, low-cost cabling like unshielded twisted pair or standard Ethernet cables. So why does this matter for you, the listener, and for their customers? Well, for automotive, it dramatically reduces the weight and complexity of the wiring harness, which is a major engineering and cost goal for car manufacturers. For Pro AV installations, it significantly lowers total system costs and simplifies installation compared to running multiple specialized cables. It's pure efficiency.
That's a crucial point because Valens is perfectly positioned at the intersection of several rapidly expanding markets. Looking at the broader industry trends, the global semiconductor market itself is on a strong growth trajectory, projected to grow over 11% in 2025 and potentially hit $1 trillion by 2030, largely fueled by AI and cloud computing. But for Valens, the automotive semiconductor market is the critical growth vector, showing explosive growth with an estimated compound annual growth rate of maybe 7% to 10%, potentially reaching over $100 billion by the early 2030s. Valens specifically estimates its total addressable market in automotive will be a massive $4.5 billion by 2029. Even the Pro AV market, while more mature, shows a steady 6% CAGR, sustained by digital transformation across corporate and educational spaces.
So who are they up against in this landscape? In terms of direct competitors, sources mention names like Indie Semiconductor and Light and Iker. Interestingly, Valens has shown stronger recent quarterly revenue growth compared to Indie, for example. But the more significant competition comes from indirect and technology alternatives. In Pro AV, HD-based take competes with solutions like HDMI for short-range stuff and various audio-video over IP or AVO IP systems. In automotive, their MIPI APHY technology is up against proprietary SerDes solutions from tech giants like Broadcom and Texas Instruments. Val's clear advantage here, and a major theme from our sources, is the industry's significant shift toward open, interoperable standards. This is a powerful tailwind.
And that shift towards standards brings us to a key strategic point about the regulatory and industry environment. The MIPI Alliance's selection of Valens's technology as the foundation for the APHY standard and its subsequent adoption by the IE, well, that was a monumental victory. It essentially means Valens's offering is becoming the industry benchmark for automotive connectivity, creating an almost unshakable competitive advantage. However, as an Israeli company with a global supply chain, they are indeed exposed to geopolitical and trade factors. The ongoing U.S.-China technology and trade tensions are a concern. Their CFO explicitly acknowledged in their Q1 2025 earnings call that they are monitoring the potential impact of new U.S. tariffs, even though semiconductors are currently exempt. It's, a risk factor to keep in mind.
Okay, so what about the protective moats around Valens? Our deep dive revealed some significant barriers to entry for newcomers. First, the incredibly high R&D costs in this industry are a huge deterrent. Developing cutting-edge chipsets requires immense capital and highly specialized teams. Second, automotive design cycles are notoriously long and sticky. Getting a design win is a multi-year process.
Yeah.
But once a chip is in a car model, it's very difficult and costly for the manufacturer to switch, creating long, predictable revenue streams for Valens. Third, Valens has built an intellectual property fortress. Our sources note they have over 100 granted patents and 207 total patent documents, which creates a formidable legal barrier. Finally, the sheer power of standardization, as seen with HD-Basic and now MIPI APHY, makes it almost insurmountable for non-standard technologies to compete once an entire ecosystem aligns around a standard.
Their competitive advantages extend to their brand strength and recognition, too. The HD-based brand is genuinely synonymous with Pro AV connectivity. They even received an Emmy Award for it, which is incredibly rare for a semiconductor firm and truly validates their technological excellence. They are actively building similar recognition for MIPI APHY in the automotive space. They also create a powerful cost advantage, not just for themselves, but for their customers. By enabling high bandwidth data over simple, inexpensive cabling like Cat6 LAN cables, Valens significantly reduces the overall bill of materials and installation labor for their clients. This is a compelling economic incentive that truly drives adoption. And the cultivation of network effects is a cornerstone of their strategy. With HD-Base, they co-founded the HD-Base Alliance, fostering an ecosystem of over 200 member companies and thousands of interoperable products. This creates incredibly high switching costs once an organization has adopted the standard. They are actively replicating this playbook with MIPI APHY being first to market with chips and fostering interoperability testing to encourage broad industry adoption. This creates a powerful self-reinforcing moat. Beyond their dense patent portfolio, they have superior digital signal processing, or DSP, expertise. Think of it as a super smart filter and booster for data signals. This proprietary tech allows them to push incredible amounts of data ultra reliably over long distances, even in incredibly noisy electrical environments, which is a non-negotiable for critical automotive safety systems. If we zoom out a bit, the strategic synergy between their two business segments is key. The CIB segment, which is mature and profitable with high gross margins, acts as a stable cash flow generator. This financial engine is what funds the long, expensive R&D and design-in cycles for the high-growth automotive segment. Essentially, Valens is a picks and shovels investment in automation and advanced connectivity megatrends. You're not betting on a specific car manufacturer. You're betting on the fundamental need for essential, standardized plumbing that connects all those sensors and displays in future vehicles.
That's a great summary of their business model and strategic position. Well, let's move on to Part 1, Chapter 2, Management Evaluation. Stewards of a long-term vision. When we look at Valens's leadership, what immediately stands out is their deep industry experience and remarkable stability. The average tenure of their management team is an exceptionally long 12.5 years, with the C-suite hailing from top-tier firms like Intel, Texas Instruments, and Xilinx. Their co-founder, Arian Lida, the inventor of HT Basic, is still deeply involved, which speaks volumes about the continuity of their technological vision. The CEO, Gideon Ben-Zvi, appointed in 2020, has actually been on the board since 2011. Our sources describe him as a three-peat serial AI entrepreneur who successfully led 3 companies to successful exits. Under his leadership, Valens launched key products, went public via a SPAC, and secured pivotal partnerships with Mobileye and major European OEMs. Now, here's a notable point. He's planning to retire by the end of 2025, though he'll remain on the board. This introduces some transition risk, of course.
Yeah.
But it's a planned long handover, which suggests a natural evolution from entrepreneurial leadership to scaling global operations. Does a leadership change at such a critical growth phase introduce any specific vulnerabilities the sources pointed out?
That's a good question. While any CEO transition carries risk, the sources emphasize that this is a planned retirement with a long transition period, suggesting continuity rather than disruption. From a communication and ethical perspective, the management team is generally transparent and direct in their public communications. They openly discuss challenges like the 2023-2024 semiconductor downturn, and importantly, they consistently beat their own lowered guidance during that period. They also proactively unveiled an ambitious 5-year growth plan, which helps shift investor focus to the long term. There's no information to suggest any ethical lapses. The long tenure of leadership points to a stable, professional culture.
Shifting to capital allocation, Valens is heavily investing in its core business. They're aggressively pouring resources into R&D to maintain their technological lead and expand into new product lines. They also have a clear, disciplined M&A strategy to augment healthy organic growth with acquisitions, focusing on synergistic, revenue-generating companies that have a clear path to profitability. The recent acquisition of Acroname, a USB extension solution company, is a prime example, and crucially, they have a strong balance sheet, over $112 million in cash and no debt, which serves as the foundation for this M&A strategy, offering significant dry powder. Now, here's where it gets interesting for you as an investor. Share buybacks. They've been quite active recently, completing a $10 million program in January 2025 and announcing a new $15 million program in February 2025, with $9.6 million deployed in Q1 2025 alone. For a pre-profitability company, this is powerful strategic signaling that management believes their shares are undervalued. As for dividends, there are none, and no plans for any, which is appropriate for a high-growth company reinvesting all capital back into the business.
This raises an important question about their return on invested capital, or ROIC. Currently, it's a significant weakness. It's deeply negative, meaning the company is actively destroying value with its investments at present. However, and this is crucial for the bull case, the entire investment thesis rests on the premise that the substantial revenue growth projected in their ambitious 5-year plan will drive ROIC into strongly positive territory, leading to significant value creation by 2029. It's a clear bet on future scale and profitability.
Now let's dive into Part 1, Chapter 3. Financial Analysis. A fortress balance sheet fueling a growth engine. When we look at the key financial metrics for Valens, as of July 10, 2025, they have a market cap of approximately $276.8 million. This firmly places them in the micro-cap segment, meaning higher growth potential, but also typically greater volatility. The revenue story has been a bit of a roller coaster. Strong growth for a couple of years, then a significant dip in 2023-2024 due to an industry-wide inventory correction. But the good news is they're forecasting a strong rebound this year, with projected revenues between $71 million and $76 million, which is a robust 23% to 31% year-over-year growth. As for profit margins, their GAAP gross margin is robust, consistently sitting between 60% and 63%. This indicates strong pricing power and a solid technological moat. However, their operating and net margins are deeply negative. This reflects their heavy investment in R&D and sales for future growth.
The path to profitability really hinges on scaling revenue over these fixed costs. Finally, their free cash flow generation has been consistently negative over the past few years, which, again, is typical for a company investing heavily for future growth.
What's fascinating here is that despite these negative earnings and cash flow, Valens exhibits remarkable financial stability, largely due to its balance sheet. For a pre-profitability company, a strong balance sheet is absolutely paramount for survival and execution. While they have a consistent history of net losses, investors are focused on the credibility of their plan to achieve profitability by 2029. Crucially, they are effectively debt-free with a debt-to-equity ratio of 0.0. This provides immense flexibility and resilience. Their current ratio is also very strong at 8.10, indicating robust short-term liquidity, meaning they can easily meet their near-term obligations. And as we discussed, there's no dividend, with all capital being strategically reinvested for growth.
So when it comes to valuation, it gets a bit tricky for a company like Valens because they're not yet profitable. Their PE ratio is not applicable. Their price to sales, PS ratio, however, is around 4.5x on a trailing 12-month basis. This is relatively high compared to the broader semiconductor industry, where many trade below 3.3x. This premium signals that the market expects strong future revenue growth due to their leadership in emerging standards, pricing them as a high-growth, high-margin business that is yet to fully realize its bottom-line potential.
This raises an important question regarding intrinsic valuation. A discounted cash flow, or DCF model, is often the best tool here. It involves forecasting future cash flows and then discounting them back to the present. For Valens, a multi-stage model is key. We'd assume high growth from 2025-2029, with revenues growing at a strong 30-40% compound annual growth rate to reach between $220 and $300 million by 2029, with free cash flow turning positive during that period. Then growth would taper to a long-term rate of 2.5-3.0%. For the discount rate, given their small size, industry volatility, and pre-profitability, a high rate like 13% is appropriate. Based on such models, the estimated intrinsic value for Valens, according to our sources, is between $3 to $4 per share.
That brings us to part 2, the horizon, in chapter 4, market sentiment, a show-me story. So how does the market perceive Valens right now? Well, the analyst consensus from the 2 or 3 analysts covering the company is a strong buy. The average one-year price target is $4 per share, implying over 45% upside from the current $2.68, with a range stretching from $3 to $5.25.
Looking at the broader media tone, it's one of cautious optimism. Positive drivers include their strong Q1 2025 results, which exceeded revenue guidance, a significant Mobileye partnership, and collaboration for the China market. There's also been successful MIPI APHY interoperability testing, and their ambitious 5-year growth plan is certainly a factor. However, these are tempered by the upcoming CEO retirement and the 2024 revenue decline due to industry headwinds, not to mention their current unprofitability. This creates what we call a valuation disconnect. Analysts are bullish, but the broader market is skeptical, largely taking a show-me stance, waiting for tangible proof of execution and consistent profitability. This is precisely where the investment opportunity lies for you as a learner.
When we look at market indicators, the short interest is extremely low at just 0.14% of the publicly traded float. This suggests very few institutional bearish bets against the company. Also, the stock's current price of $2.68 is trading above both its 50-day and 200-day simple moving averages, indicating both short-term and long-term uptrends. This alignment of positive fundamental and technical signals suggests the stock may have already bottomed out and is now in the early stages of a new long-term uptrend.
Let's move to Part 2, Chapter 5, Ownership Structure. A blend of venture capital, legacy, and public institutions. A key insight here is the mix of institutional ownership. Our sources indicate it ranges from 18% to 45%, depending on how it's calculated, but it includes both venture capital firms that back them pre-IPO and a growing number of public market institutions. Top holders include Value-Based Ltd. At nearly 20% and Lens Capital LLC at over 10%. The increasing number of institutions holding positions is generally a bullish sign, and the fact that legacy investors like Lens Capital are still holding shares post-SPAC signals their continued belief in future upside.
Now, when it comes to insider holdings, they own a meaningful 8.06% of the company, with the CEO, Gideon Ben-Zvi, personally owning about 0.24%, valued at over $660,000. While we've seen some recent insider sales, our sources indicate these were part of pre-scheduled financial plans. This is important for you to understand, as it means they're routine financial planning and not a bearish signal about the company's future.
This raises an important question about ownership concentration. Their ownership is fairly concentrated, with the top two institutions controlling about 30% of shares. This can provide stability from committed investors, but it also means that decisions by a few key stakeholders could have a significant impact on the stock's liquidity and price.
All right, let's turn our attention to Part 2, Chapter 6, Risk Assessment. High reward potential, tempered by significant risks. We'll start with the internal strengths revealed in our deep dive. Valens' core strengths are clear. Their technology leadership and standard-setting ability, first with HD Baytech and now with MIPI APHY. This is deeply protected by a robust intellectual property portfolio boasting over 100 patents. And crucially, they're financially rock solid, operating with a fortress balance sheet that's over $112 million in cash and zero financial debt. All of this is guided by an experienced and notably stable management team, averaging 12.5 years of tenure.
However, their internal weaknesses include current unprofitability and cash burn, which remains a primary risk for investors. Historically, there's been some revenue concentration in automotive, with a significant portion tied to Mercedes-Benz, though they are actively diversifying. And as a microcap company, they operate with a smaller scale and fewer resources compared to giant competitors.
But the opportunities for Valens are truly massive. The automotive addressable market, estimated at a staggering $4.5 billion by 2029 for their ADAS and autonomous driving chipsets, is a game changer. They also have opportunities to expand into new verticals like industrial machine vision and medical imaging. Their strong balance sheet gives them the dry powder for strategic mergers and acquisitions to accelerate growth. And the growing APHY ecosystem, with more vendors and OEMs adopting the standard, is a powerful tailwind for them.
On the other hand, there are significant external threats. The semiconductor industry is notoriously cyclical, and Valens was directly impacted by the 2023-2024 downturn. There's intense competition from large, well-funded companies. The long and often uncertain automotive design cycles mean years of effort without guaranteed success. And as we discussed, the planned CEO transition introduces an element of leadership risk.
From a macroeconomic perspective, management has identified high inflation and rising interest rates as headwinds. These factors can slow down customer decision-making, impacting their CIB projects and potentially dampening consumer demand for new vehicles, which would affect their automotive segment.
Geopolitical factors also pose a direct threat. The U.S.-China trade tensions, specifically the risk of new U.S. tariffs, was acknowledged by their CFO in Q1 2025 earnings. While semiconductors are currently exempt, tariffs could impact supply chains, increase costs, or limit market access, particularly in the critical Chinese automotive market. This raises an important question. The primary risk facing Valens is one of execution, not technology. Its technology is proven, its balance sheet is robust, and the market opportunity is clear. The greatest uncertainty is whether management can successfully execute its ambitious 5-year plan to more than quadruple revenue and achieve sustainable profitability. Furthermore, for you as a learner, it's crucial to distinguish between cyclical headwinds like the 2024 revenue decline from industry inventory correction and the powerful underlying secular growth trends in ADAS and AV connectivity. The strong 2025 guidance suggests this secular trend is indeed reasserting itself.
That brings us to Part 2, Chapter 7. Conclusion. To synthesize our findings, the key bullish points for Valens Semiconductor are compelling. They have a dominant and defensible competitive moat built on standard-setting technology like HD Basi and MIPI APHY. They are picks and shovels play on the massive vehicle autonomy megatrend, leveraging a proven playbook in a far larger market. This ambitious growth plan is backstopped by a fortress balance sheet with over $112 million in cash and no debt. And they have a clear, detailed 5-year plan to more than quadruple revenue, supported by a strong buy consensus from analysts and a near-total absence of short seller interest.
However, the bearish points are also significant. The primary risk is execution, delivering on that ambitious plan and achieving profitability. They are currently burning cash and have a history of net losses. They operate in a fiercely competitive and cyclical industry and are exposed to macroeconomic headwinds and geopolitical risks like tariffs. There are also risks from customer concentration and the long, uncertain automotive design cycles. And the planned CEO transition introduces some uncertainty into the mix.
In terms of valuation summary, as we discussed, traditional PE is not applicable due to negative earnings. But a forward-looking discounted cash flow model suggests an estimated intrinsic value of $3 to $4 per share.
So what does this all mean for you? Valens' current share price of $2.68 trades at a notable discount to this estimated intrinsic value range. This suggests the market is pricing in significant execution risk and taking a wait-and-see approach. Valens represents a classic high-risk, high-reward investment opportunity. For patient, long-term investors with high-risk tolerance who believe in its technological moat and management's execution, the current price might be an attractive entry point. Conversely, if you prioritize near-term profitability and lower volatility, the risks might be too high. The company must successfully transition from a standard setter to a profitable, at-scale enterprise to fully reward its shareholders.
As you consider Valens Semiconductor, ponder this. In an era of rapid technological change, which singular factor, be it patents, partnerships, or leadership, do you think is most critical for a small, standard-setting company to navigate its path from hidden gem to market leader? If you enjoyed this deep dive, make sure to like and subscribe to the Stock Analytics AI YouTube channel. Our 4.999-month members get priority deep dives on tickers, and over the next few months, we're covering all of the S&P 500 stocks with exclusive priority access for members. If you want a one-off deep dive on a specific stock, just drop us a super thanks. And remember, members can add stock suggestions for future videos in the comments, and we will pick them up.
Please remember that this analysis was generated by an AI system for educational purposes only and should not be considered financial advice. Always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.